People were told debt was a tool, something you could manage, something you could control. As long as you were responsible, as long as you paid on time, as long as you didn't overdo it, debt was supposed to help you move forward. A bridge, a temporary boost, not a threat. But what if that belief is outdated? What if the real danger of debt isn't reckless borrowing, but the moment when debt stops being flexible, when it stops being invisible, when it stops being forgiving? And what if 2026 is the year that change becomes impossible to ignore? This is not a warning about people suddenly becoming irresponsible. It's a story about timing, about pressure, about a system that spent years encouraging debt, normalizing debt, and building entire economies around it. And now, slowly, quietly, tightening the screws. This documentary explains why debt starts to hurt in 2026. Not for the reckless few, but for millions of ordinary people who did exactly what they were told to do. For most of modern life, debt was framed as opportunity. Student loans meant education. Mortgages meant stability. Credit cards meant flexibility. Even governments treated debt as a lever for growth. Borrow now, grow later, pay it back when things are better. And for a long time, that logic worked. Interest rates were low, payments were manageable. Inflation made old debt easier to carry over time. Debt faded into the background of daily life, like a low hum you barely noticed. But debt only feels harmless when money is cheap, when growth is steady, when income keeps rising, when tomorrow looks better than today. That's the condition debt depends on, and that condition is weakening. Debt doesn't break suddenly. It tightens gradually. Payments get heavier, options narrow, flexibility disappears. And in 2026, many of those slow pressures converge at once. To understand why, you need one simple idea. Debt is a promise about the future. When you borrow, you're betting that future income will be strong enough to carry the cost. Not just this year, but year after year. Debt works when the future expands. It hurts when the future stalls. For years, the system assumed growth would solve everything. Rising wages, rising productivity, rising asset values. But while asset prices climbed, wages lagged. And while borrowing increased, the margin for error shrank. Debt didn't just grow, it became structural. Student loans stopped being short-term. Mortgages stretched longer. Credit cards filled gaps between paychecks. Buy now, pay later turned everyday purchases into installment plans. Debt moved from investment into survival. And the incentives pushed it further. Banks profit when people borrow. Companies profit when people finance consumption. Governments avoid hard choices by borrowing instead of cutting or raising taxes. The system rewarded expansion, not restraint. So debt spread everywhere. Quietly, normalized, even celebrated. Being debt-free stopped being realistic for many people. It became something only the lucky or the early could achieve. Then conditions started to shift. Inflation rose. Interest rates followed. Not dramatically at first. Just enough to matter. Just enough to change the math. Here's the part most people don't think about. When interest rates rise, debt doesn't just cost more. It becomes less forgiving. Adjustable rate loans reset. Credit card balances snowball faster. Refinancing options disappear. The exits close. A payment that felt manageable at 3% feels heavy at 7%. A balance that once shrank now grows. And the system doesn't care whether you borrowed for education, housing, or groceries. The obligation is the same. This is where 2026 comes in. Because by then, many people are no longer adjusting to change. They're absorbing the full weight of it. Higher rates, higher prices, stagnant income, all at once. Consider someone who did everything right. They took a student loan to get a degree, a mortgage to buy a modest home, used credit sparingly to handle emergencies. Nothing reckless, nothing extreme. For years, it worked. Payments were steady. Life moved forward. Then costs rose. Groceries, energy, insurance, rent, Taxes. Not dramatically, but relentlessly. And suddenly, the margin vanished. Now imagine that person in 2026. Refinancing is harder. Credit costs more. Savings are thinner. One surprise expense creates a chain reaction. Not because they failed, but because the system left no slack. Debt becomes painful not when people are irresponsible, but when there's no room to breathe. There's another side to this story that rarely gets attention. Debt doesn't hurt everyone equally. For those with assets, debt can still be a tool. Inflation reduces the real value of what they owe. Rising asset prices offset interest costs. Debt amplifies gains. But for people without assets, debt is gravity. It pulls future income backward. It turns time into obligation. The same system produces opposite outcomes depending on where you start. This is the hidden transfer. Risk flows downward. Stability flows upward. The closer you are to assets, the more forgiving debt remains. The farther you are, the more punishing it becomes. And no one sends a warning. There's no announcement that says, debt is about to hurt now. It shows up quietly, in declined applications, in higher minimum payments, in anxiety that never fully turns off. By 2026, the emotional cost becomes visible. Stress becomes chronic. Burnout increases. People stop planning long-term because they're busy managing monthly survival. Debt stops being a background condition and becomes the main character. This is where the old story breaks. The story that says debt is neutral, that it's just a tool. That responsibility alone protects you. It doesn't. Debt magnifies conditions. When conditions are good, it feels invisible. When conditions tighten, it hurts fast. The real rules are simple but uncomfortable. Debt assumes growth. When growth slows, debt exposes weakness. Interest rates don't need to explode to cause damage. They just need to stay higher for longer, and flexibility disappears. This doesn't mean catastrophe. It means contrast. It means some people absorb the pressure while others feel crushed by it. Not because they're smarter or harder working, but because the system treats debt differently depending on who holds it. So what can people do in a world where debt starts to hurt more? First, understand that not all debt is equal. Debt used to survive is fragile. Debt backed by income alone is risky. The less room you have, the more dangerous debt becomes. Second, protect flexibility. Emergency savings aren't about growth. They're about breathing room. Even small buffers matter more in a tight system. Third, be honest about exposure. Know which debts can change. Variable rates, revolving balances. These are pressure points. Understanding them doesn't eliminate risk, but it reduces surprise. And finally, stop blaming yourself for structural pressure. Debt pain doesn't mean failure. It often means timing. And timing is not something individuals control. The most important shift is mental. When you see debt clearly, you stop treating it as a personal flaw and start recognizing it as a system feature. A feature that works smoothly in expansion and painfully in contraction. By 2026, debt doesn't suddenly appear. It reveals itself. The system doesn't collapse. It tightens. And the difference between people who can absorb that tightening and those who can't becomes visible everywhere. Understanding this doesn't solve everything, but it changes how you move, how you plan, how you judge yourself, and how you interpret pressure when it shows up. If this helped you see things more clearly, take a moment to like the video, share your thoughts in the comments, and subscribe to Rise and Ruin, Power of Wealth for more documentaries on money, power, and the forces shaping our future. Because debt doesn't hurt all at once. It hurts when the system changes. And in 2026, that change is no longer quiet.